Welcome back to the channel, and welcome to today's deep dive. Ethereum has been on a remarkable run this year, and the conversation has shifted from, can it hold above $4,000 to is $7,000 realistic by the end of the year? This isn't just retail chatter or speculative hype. Serious analysts, institutions, and even some of the most cautious voices in the financial world are beginning to talk openly about Ethereum breaking through levels that once seemed far away. Nolan from CoinShares recently said, and I'm quoting him directly here, "This isn't just a speculative rally. Ethereum has shown structural momentum, with institutional flows and macro clarity creating a perfect backdrop for the next leg higher." That's the kind of language you don't usually hear unless something fundamental is happening. So in today's episode, we're going to spend some real time breaking this down. Why are analysts like Nolan calling for 7,000 ETH? What does Standard Chartered see when they raise their target to 7,500? What's happening with exchange flows, with ETFs, with staking, and with whales that makes this scenario possible? And what are the risks that could stop Ethereum from getting there? By the end of this episode, you'll have the full picture of what's driving this market, where it could go next, and whether the 7,000 call is just bold talk or grounded reality. Let's start with where we are now. Ethereum has been on a 75% rally in the last 90 days. From the depths of spring consolidation to a summer breakout that carried it to new highs just shy of 5,000, ETH has been one of the strongest large-cap performers. This isn't a meme coin pumping on hype. This is the second largest cryptocurrency in the world, delivering returns that outperform equities, outperform bonds, and even outperform Bitcoin in key stretches. When Standard Chartered, one of the most conservative banks in the world, raises its target for Ethereum to 7,500 by year-end, it's worth listening. They don't make those calls lightly. Their analysts specifically cited institutional inflows, the regulatory clarity brought by the Genius Act, and the acceleration of tokenization on Ethereum as reasons they see the rally extending. Now let's talk about the inflows, because this is one of the most important drivers. Ethereum ETFs are rewriting the rules. In the past month alone, spot Ethereum ETFs have attracted billions of dollars, with one record day seeing over 450 million in inflows, compared to just 88 million for Bitcoin ETFs on the same day. That's not a small difference. That's a tidal shift in institutional demand. Nolan said in his latest commentary, "Institutions are no longer treating Ethereum as a speculative add-on. They're treating it as yield-bearing programmable money, and that changes everything." That quote captures the moment perfectly. For the first time, institutions aren't buying Ethereum because it might go up in price. They're buying because it provides yield through staking, deflationary mechanics through fee burns, and programmable utility through smart contracts. This isn't just about price, it's about classification. Bitcoin is digital gold. Ethereum is programmable infrastructure. And that difference is starting to matter in boardrooms, in hedge funds, and on trading desks. When you hear that funds are now allocating to Ethereum as part of their core yield strategies, you know the narrative has shifted. On-chain data backs this up. In just a 2-day stretch earlier this month, more than 200,000 ETH, worth almost $1 billion, was moved off exchanges into cold storage. That's not retail traders. That's institutions and whales securing their positions. And it's not an isolated event. Exchange balances of Ethereum are at their lowest levels in 5 years. Staking has locked up over 35 million ETH, which is almost 30% of the entire circulating supply. Corporate treasuries now hold more than 4 million ETH, or just over 3% of supply, and that number is growing every quarter. When you combine ETF demand, whale accumulation, and staking lockups, you start to see why analysts are confident about 7,000. It's not just buying pressure, it's a supply squeeze. There's simply less ETH available to trade. Every time a whale stakes, every time an institution locks up ETH in cold storage, the float shrinks. That makes the market thinner, and thinner markets move faster when demand spikes. That's why we're seeing these sharp rallies whenever news hits. Let me put that back to you. If whales and institutions are pulling nearly $1 billion worth of ETH off exchanges, would you want to be selling into that? Or would you want to be buying alongside them? Now, let's talk about the technicals. Ethereum recently formed a classic bull flag pattern around the 4,700 to 4,900 range. Technical analysts love this pattern because it usually signals continuation. With the MACD rising, the relative strength index holding strong, and money flow indicators flashing green, the setup is there for a breakout. One prominent technical analyst put it this way: if Ethereum can clear 5,000 cleanly and hold, the next resistance doesn't come until 7,500. That's the exact number Standard Chartered highlighted. You don't often see technicals and conservative bank forecasts align, but right now they do. Now picture this. Ethereum breaks above 5,000 cleanly, Standard Chartered's 7,500 target flashes on headlines, and suddenly retail piles in alongside institutions. Can you imagine the speed of that move in a market where so much supply is locked? This isn't theory. We've seen Bitcoin do it in past cycles. The setup for Ethereum now looks eerily similar. But let's not kid ourselves. Every rally carries risk. Imagine Ethereum at 6,800, everyone celebrating, and then regulators slam DeFi protocols overnight. Gas fees collapse, burns slow, and suddenly the deflationary narrative evaporates. That's the kind of shock that could slice the price back down fast. Would you hold through that? Or would you take profits before the hammer drops? We are going to give you one final quote from Nolan and show why the risk-reward still excites analysts like him. He said recently, "Ethereum isn't just a speculative asset anymore. It's programmable, it's yield-bearing, and it's structurally deflationary." Notice that language. It's not moonboy hype. It's sober analysis. And it's why people believe 7,000 is within reach this year. Quick word from our sponsor. If you're holding crypto, make sure it's safe. Grab a Ledger hardware wallet if you don't have one already. Links in the description. Now let's zoom out. Ethereum isn't competing with meme coins. It isn't competing with Bitcoin either. It's competing with the entire financial system. Every upgrade, every ETF, every staking deposit is one more brick in a new wall of money. That's why banks like Standard Chartered are bold enough to set targets that would have sounded ridiculous a year ago. One of Ethereum's biggest advantages right now is yield. With staking rewards averaging between 4 and 5% annually, Ethereum offers something Bitcoin doesn't. It's not just a store of value, it's a productive asset. For institutions, that's a game changer. They can hold ETH, earn yield, and potentially see price appreciation. That's a triple benefit. And because so much supply is being staked, the circulating supply is effectively shrinking, amplifying the impact of demand. The deflationary aspect is another powerful driver. Since the London hard fork and the implementation of EIP 1559, a portion of every transaction fee on Ethereum is burned. In times of high network activity, more ETH is burned than issued, making the supply deflationary. Combine that with staking and ETF inflows, and you get a tokenomics model that's increasingly attractive to long-term holders. Upgrades also matter. The Denkin upgrade slashed gas fees on Layer 2s by as much as 90%, making Ethereum more usable and scalable. The upcoming Pectra upgrade is expected to further optimize execution and expand developer tools. Each of these upgrades strengthens the network, making it more efficient and more attractive for builders and users. This constant improvement cycle is one of the reasons analysts like Nolan and banks like Standard Chartered are comfortable making bold price predictions. Ethereum isn't standing still. It's evolving, and every upgrade reduces friction and increases adoption. So here's my question for you. If you had to pick only one for the next 5 years, would you pick Bitcoin's digital gold or Ethereum's programmable yield? Drop it in the comments, because your answer says a lot about how you see the future of finance. And as we wrap up, think about this. Whether Ethereum hits 7,000 this year or not, it's forcing institutions, regulators, and everyday investors to rethink what money can be. This isn't just a coin anymore. It's becoming infrastructure, it's becoming yield, and it's becoming a foundation that rivals the old system. So whether you think 7,000 is fantasy or destiny, one thing is certain. Ethereum is rewriting the rules of money right in front of us. And that's why we'll be here tomorrow, watching it unfold together. We will see you at the top.